Okay, so hello everyone. A very good afternoon, very good evening to all of you. And thank you so much for joining. So, we are just going to wait for maybe 10 to 15 seconds, 30 seconds for some more people to join in. And then we are going to start this particular session, which is India Karega Invest. So, welcome all of you. Yes, now I can see people joining in. Thank you so much. Hi, can I get some hellos on the chat? Can I get some hello on the comment from all of you? Whoever's already joined the call. Hi, Tashar. Hello, good evening. Yes, so can I see some more people joining in? And some more people, can I get some highs from all of you? So, yes, I can see Tushar, I can see Kirti. Hello, Kirti. Hi, Shrikant. Good evening. Welcome, all of you. Hi, Rahul. Hello, Akshay, Manoj. Yes, I see a lot of people now. Thank you so much for joining in, guys. Hi, Aman. Okay, so I think we can start today. The India Karega Invest series is back again, and we are having a very interesting topic for all of you. We have a very amazing speaker as well. So today the topic is going to be on behaviors. Today the topic is going to be on what are the mistakes that some of us make when it comes to investing. What are some of the behavioral mistakes that all of us mistake, and how can we rectify those mistakes, right? So I'm Namrata, and I'm going to start with a quick introduction of the topic, followed by the speaker, and then we're going to have a Q&A for about 10 to 15 minutes. Yeah. So all of you, if you have any questions, keep posting it on the comments, and we're going to take all the questions towards the end of the session. Yes, all of us are super excited to hear Akhil talk about this topic. So yes, so keep the questions going, guys, and I think I will start from my side. So let me quickly share my screen with all of you. Just give me 1 minute. Hi, hello, Harendra. Okay, so yes, so let me start, by talking about behavioral biases. So come to look at it, right? When it comes to investing, there are a lot of times when we see amazing returns from equities, right? It could be stocks, it could be mutual funds that we are investing in. Come to look at it, if you just look at this particular slide that I'm going to show you, there have been funds that have given 211 time returns in 25 years. So had you invested, say, a lakh, it would have become about 2.1 crores in 25 years. Even if you look at some of the stocks, right, there have been stocks which have created so much wealth for investors. From a 5 rupee, the price has gone up to 7,045 in a span of, say, 15, 16 years. And we hear all these amazing stories, right? But the point is, do we actually know of investors? Do we know of people who have made these kind of returns? It's very rare that we come across people who made such returns. We hear these stories, of course, right? The challenge is that very rarely we meet people who actually stayed invested in equity for 10, 15, 20 years. And that is the biggest problem. So come to look at it, when it comes to returns, right? So when we're looking at equity mutual fund holding, this slide is very interesting, which tells you that as of 2021, 45% of the investors held on to the equity investments for less than 2 years. So just think about it. We are always talking about equity for long term. We are always saying that, you should, if you invest for long term, you can see that wealth creation in equities. But then why is it that people are taking out money in less than 2 years? 2 years is not even a time horizon for an equity investment, right? So why is it? And this is not just a 1 year trend, by the way. This has been the trend in the past few years. So the problem is that why is it that people are taking out money? Why are they booking their profits so early? Because if they're booking their profits so early, they'll not be able to see that kind of wealth creation that we have the potential to see in the 10, 15 years kind of a time frame, right? So the question is, why is it that the fund returns are different from the investor returns? Why is it that the investors don't get to see those kind of returns which the fund is giving, right? So what could be the reason? So the reason is truly behavior, and it is not a logical reason because of which this is happening, right? So if you just look at this particular screen, I'm just going to maximize my screen for all of you to see. So, for example, when you see the markets going up, you actually see a lot of optimism, right? You actually see people are excited about investing. They're excited about being a part of this journey because they see the market trend moving upwards, right? Then, of course, there are times when we become greedy as well, and we're like, okay, I'm looking at those great returns, and then it reaches that euphoria. Euphoria is when people start assuming that I'm the smartest, I've made like the best returns, I know everything about investments. I have people in my own family who've started investing in stocks in the last 1 year, and today they're talking about investing in IPOs and investing in stocks, and they have their own analysis in place, and they truly believe that it's a great time. The problem is that they've not really seen the downside, right? Which a lot of other investors have. And when you see the markets coming down, there's a time that you get anxious. You're like, okay, maybe it's just a temporary thing. And then it reaches a denial phase. The denial phase is when you just say that, I don't think the market is going to go down below this. And then, of course, the markets continue to go down and you reach that panic situation, right? So, what I'm trying to tell you is that this is the investor behavior cycle, right? This is the cycle that tells us that investors behave in a particular pattern based on how the markets are performing. Yes, there's a very beautiful saying that says that even a short term trader becomes a long term investor when his call goes wrong. Yeah. So, I'm sure all of you have heard of Sir Isaac Newton, right? He's a physicist, mathematician, scientist, and all of that, a very logical guy. But I don't know how many of you know this, but he was also an avid investor, and he had invested in the 1720s in a company called the South Sea, which the stock price of that company soared from 128 to 1050 pounds in just from Jan to June of that particular year. Newton sold his profit at 100% and made about 7,000 pounds, which was great. But he also couldn't resist the rally. And he reinvested back all the money that he had made and then lost 20,000 pounds, which in today's estimate is close to 3 million pounds. By September, the stock price was back to 175 pounds. And he made this wonderful statement which said that I can calculate the motions of heavenly bodies, but not the madness of people. So, what I'm trying to tell you is that even someone as logical, as rational as Newton fell into the behavioral trap. Yes. So, what I'm trying to say is that why do we make these mistakes? What is it about investor behavior? There are a lot of times that investor behavior is determined by, we actually inherit these experiences from our family, from our parents, because, come to look at it, there are a lot of times when our parents, the kind of investments they made versus the kind of investments we make are very different. For our parents, for example, retirement was never a goal, right? Because for them, it was just assumed that they will work till they're physically fit, and after that, their kids will take care of them, isn't it? They never invested in equities because at the time when our parents were in their prime, the equities were not a very regulated market. There were so many scams happening. There was so much, so many problems that our parents really stayed away from equity, and they believed that equity investing was gambling. But that is not the case now. So what I'm trying to tell you is that investor behavior, to a large extent, is determined by, at least our behavior is determined by how our parents used to invest, and that may not be the right thing to do because our goals are very different from our parents' goals. So what are some of those mistakes that we make as investors, right? So first we call it as a loss aversion theory. So this basically means that we just want to avoid losses at any cost, right? So for example, we keep looking at particular stocks, and we are like, okay, what's the 52-week high, what's the 52-week low? We're always tracking these numbers, yeah. And when it's time to book our profits, what do? We look at the best performing stocks, and we get rid of them if we feel that the markets are going to go down, and we keep the non-performers. So think of it, if you're running a company, yeah, and you have to sack someone, you have to fire someone, would you fire the performers or the non-performers? Obviously the non-performers. But when it comes to our investments, we just get rid of the performers, and we want to recover all our losses from the non-performing stocks, right? And also when we look at the loss aversion theory, it also says that suppose you've invested a lakh, yeah, and now it's become say 1.2 lakhs. So you are happy about it. You feel that okay, I've made 20% profit. But the same 1 lakh, if it has become 80,000, yes, then that loss that you made of 20% is going to pinch you more than the happiness that you got when you got the 20% profit. So basically, it says that the fear of or the pain of losing is much higher than the happiness that you get from a particular profit in a particular investment, and that is loss aversion theory. Second is anchor. We call it the anchoring bias, which basically means that every time when we are looking at investing, so for example, last year markets went down from 42,000 to 28,000, and obviously people were in a panic mode. But then the market started recovering, and when they touched 42,000, you had a lot of people who were booking their profits, because in their mind they had already set an anchor at 42,000. Yes, so the problem is we keep these anchors in our head, and then we're not even able to anticipate what could happen going forward, right? Maybe so we thought that I don't think the markets would go beyond 42, beyond 45,000, and look at where we are today. So the moment you set an anchor in your head, you will just you'll just book your profits early, and that may not be the right thing. And then of course getting carried with the current trend. So come to look at it, today everyone's talking about cryptos and equities, but then everyone says I should invest only in equities or only in cryptos. That may not be the right thing, right? I mean, a set allocation is something that we all look at. There are other boring investments like maybe gold that you should be a part of to some extent, right? You have to diversify. So getting carried away with current market trend may not be like the best strategy for the long term. And of course, how do you do course correction? Super simple, right? Have your financial goals in place. I mean, I think we can speak less about it, but then you have to have your financial goals and make your investments as per your financial goals and stick to that asset allocation. Don't get carried away with markets doing well and you want to book your profits. Take out your money when you're going to achieve that goal, right? And then don't really look at, don't have these knee jerk reactions where you're just reacting to a particular situation. Think logical and respond. If you think it works for you, then go ahead and do it. Yes. So that was my little bit on behavioral investing, and I do think we're going to get so much more insights from Akhil Chaturvedi on this particular topic. So I would like to call on Akhil. He's a chief business officer at Motilal Oswal. Akhil, please take over and do enlighten us on this particular topic. So I'm just going to add Akhil to the stream. Hi, Akhil. Welcome.
Hi. Yeah, hi. Thanks, Namrata. And
Thank you.
good evening, friends. It's a pleasure really to talk to all of you, interact with you this evening on this very, very important topic, which is on behavior. Namrata has really spoken a little bit conceptually as to what kind of behavior biases are there amongst all of us as investors, including me as investor, and what do we learn from these biases, and how do we improve our investing principles, our the way we plan our financial goals, the way we choose our asset classes, different asset classes at different points of time. How do we bring long term investing culture in ourselves? A lot of things. I think Namrata has given the initial feeler on the same. Some of what she has spoken would be covered by me as well, so some of the concepts would be repetitive, but I've just tried to put in some of my thoughts, which comes more from learning from my own experiences, and number two, interacting with investors on a daily basis. Being part of the asset management company, we interact with retail investors, we interact with high net worth investors, we interact with family offices, so we interact with institutions across segment. We interact with a lot of investors, and as we interact, obviously we learn their thought processes, and that all those thoughts, whatever learnings are there, I've tried to capture this in this small presentation, which should not take more than 30 minutes outer side, and hope the content in the presentation will be able to give you some more insights into your investment principles, your investment practices. And after the presentation, I would be glad to take any questions there. So just bear with me for a minute. Share screen. Namrata, is this visible?
Yes, it's visible.
So this is the headline. I like this headline quite a lot. In investing, I think it's very important to have the vision to see into the future, different asset classes, your goals. So what is your vision about your investing goals? Once you have had that vision, then obviously you need to have the courage to buy the same, or get yourself invested. And then the final thing is about patience. And these three words basically come from a very very famous author called Thomas Phelps. We read his book on investing, and we really like this the way he's put it, that in investing it is all about having the vision, and then having the courage, and then having the patience. And patience is actually the rarest of three. We may be right on our vision, we may be really having the courage to actually buy, but eventually when the markets goes into swings, and not only equity markets, even debt markets will go into cycle, real estate market, any asset class, the prices are subject to change, prices are subject to volatility, depending on the macroeconomic environment. And there is where the patience comes to test. And this brings to this whole concept, which comes from Carl Richards. Most of you would have read him, and he talks about the behavior gap. So what you see out here is basically on the left. This is the return which is produced by the market, whether it is equities, whether it is fixed income, whether it is gold, any asset class. If you remain invested for a long period of time, eventually you make X return. So if you remain invested into the market for the full period, then this is what the market gives you on the left, which is which clearly shows a higher return. And on the right, what you see is the average return which actually the investor makes. And the gap between these two is basically called the behavior gap. What essentially this is showing is that investors are not making as much return as the market is making, right? And what we will try to see or understand in the next 30 minutes or so is why this happens, and how we can improve ourselves to ensure that we make at least as much as the market makes, if not beat the market in the long run, right? But this is the whole behavior gap which we are trying to address in this conversation. Putting this into numbers, what we are seeing out here is, again, we look at S&P 500. Now S&P 500, if you see, in last 20 years, after going through all the ups and downs, has produced uh, a return of, let's say, 7.2%. Whereas actually, and this is actual research data, on an average American investors would have earned a return of 5.3%. Similarly, on the right hand side, if you look at fixed income, in 20 years, US market or US fixed income markets would have produced a return of 4.6%. But actually average return made by the investors is just about 0.4%. Now, what I make out from this data, or this slide, is basically, if I would have remained invested in S&P 500 for the last 20 years, full period, without any pauses, without moving out, making fresh entry, trying to time the market, book profit, cut losses, not doing anything, simply 20 years I've sat on the S&P 500 underlying top 500 companies of the US, I would have made a return of 7.2% without doing anything, simply sitting tight. Against that, if I would have tried to time the market, tried to get out of the market when usually what happens is you get out of the market when the markets are going down, and you try to get into the market when the markets are going up. This is what is also called the anchoring bias, which Namrata spoke about. If I would have tried to do that, then my return would have actually been lesser than the market return, of which is the S&P 500 return, 7.2%. My return would be about 200 basis point lower than the S&P 500 return. So is the case with the fixed income. So essentially what we are saying, and I will keep repeating this again and again, is that it's not about investing into equities or fixed income or real estate or gold or any other asset class. It is all about eventually assessing your goals, your financial goals. What are your short term goals? What are your medium term goals? What are your long term goals? And basis your goals, you decide your asset allocation. When you are investing for shorter period of time, you need to have more of fixed income, less of equities. When you are investing for a medium term time frame or investment horizon, then you need to have a balance between equity and fixed income. And when you are investing for very, very long term, usually this would be for your retirement. At that, for that goal, you need to have a much higher allocation towards equities, because you have a longer time frame, you can take more risk, and you can benefit from compounding. So depending on your financial goals, you have to choose the various asset classes. And then, irrespective of the market movements, irrespective of what's happening in the economy, irrespective of whatever is happening around us, irrespective of what other people are doing, irrespective of what your friends are doing, you need to remain committed to your financial plan. You need to be committed to your financial goals. Simply keep quiet. If your goal is for 5 years, you have invested 50% equity, 50% fixed income, then remain invested 50-50 for the 5 year time frame. And when you are doing your asset allocation 50-50%, for example, for 5 years, in between, if the equity market goes up and your equity valuation goes up from 50%, let's say, to 70%, then you rebalance your portfolio by booking profits, that extra 20% what you made, bring it back to 50%, right? So by following that plan, by default, you are booking profits at regular intervals and you're buying at lower levels. So it's a kind of a auto rebalancing, and it will also help you manage your risk better and eventually help you achieve your goal, right? So this is the first framework. What I wanted to share with you is the whole difference between the market return and the return which all of us make as investors by being more reactive. I think when it comes to investing, not reacting probably is a better strategy than reacting at different points of time. So that's the first thing. uh, Before I get into the main presentation, what I wanted to share with you is that when this topic came to me for discussion, so what I did was I went into the Google and I just typed behavior finance, and obviously there is a lot of work which has been done by a lot of financial analysts, uh, people who practice financial planning, and they are in the business of advising clients. A lot of papers have been written on the various biases which they have faced when they interact with the investors. And i would I would recommend that all of you do this googling and do some deep study to understand all of these biases, some of which Namrata has covered in her initial introduction talk, and you will understand and you will actually relate some of the biases which you yourself actually go through. But when you go through them, you will find that they are a little bit technical. There could be language which probably could be difficult to understand, and there is a lot of reading material in that. What I try to do is that in my presentation, try to take some of those concepts but put it in a simple format, in a pictorial format, so that you can understand what these experts are trying to talk about in their research papers, right? So we spoke about the vision, courage, and patience. So let's understand the first mantra, vision to see. And vision to see, when I'm saying, is we are trying to look at our financial goals and how we are planning our asset allocation. So we have taken the three popular asset classes out here. Eventually, a traditional Indian investor will effectively be investing in three and plus one, I would say, real estate. Real estate data is not available, so we have not tracked it out here. But eventually, you look at equities as one option to invest. Gold is a very popular investment. So that is one asset class which you might probably consider. And then obviously fixed deposits is the most preferred investment option. Obviously you don't lose money, but absolutely you don't make returns as well. So these are some of the asset classes which are available to you. But before you decide which asset classes are available to you, I think, given the current scenario, when the interest rates are going down, inflation is still high, it is very important to look at your returns or your return goals adjusted for taxation and inflation, right? What is your real return? Because eventually, after paying taxes and after adjusting for the inflation, whatever you are left with is the real purchasing power which you will compound. It is the actual compounding of purchasing power which will help you buy same or more of the goods or the services or whatever it is, uh, going forward into next 5 years, into next 10 years, into next 15 years, right? So one has to focus at real returns and not total returns. So in isolation, a 6% product or a 8% product or a 12% product means nothing, right? But whatever the gross returns from whichever asset class, whether it is equity, whether it is gold, whether it is bank deposit, you have to look at the average inflation adjust the inflation. So you minus the inflation, then you pay taxes on your return, so you minus that, and then what is left in your hand, accordingly you have to choose asset classes to achieve your goals, which are looking forward. Now, putting this into a live example, this is a small calculation out here just to explain what I'm trying to say. So on the left, you see there is a traditional fixed deposit uh, generating you a pre-tax return of 6%. On the right, you have equities, and equities over a period of time have delivered 15%. Sensex, since the time 1979, it came up, it took birth at 100 points. Today is 62,000. So basically, your compounded return has been 15%. So your gross return from fixed deposit has been 6%. Gross return from equities is 15%. Adjusted for tax, your post-tax return in fixed deposit is 4%. Adjusted for taxation in equity, which is 10% long term, it is 13.5%. Adjusted for inflation, 5%, right? So 6% comes down to 4 after tax. After inflation, 5%, your net real return actually in fixed deposits or fixed income investments is negative 1%. So you are not, I mean, forget about the purchasing power or increasing your purchasing power. Actually, you are losing the purchasing power. uh, After a decade or 2 decade or 3 decade, if you are invested or over invested in fixed deposits or similar products, then you will lose your purchasing power. You will not be able to buy enough of what you buy today after a decade or 2 decades or 3 decades, as compared to equities. Because the returns are higher at 15% on an average. Adjusted for taxation, it comes down to 13.5%. Adjusted for inflation, you make 8.5%. So basically, every year your purchasing power every 8 years your purchasing power will double, with a net positive or net real return of 8.5%. Now you look at gold is similar return to a fixed deposit. It's inflation adjusted, so you will barely be able to make as much money uh, as the inflation is. Again, you pay tax, and the net real return will turn negative. So what we have seen is that as India is growing, as the economy is growing, as we are getting more and more globalized, we are seeing that the interest rates are actually coming down, and Indian investors are now getting smarter, and they are understanding that uh, that that to become rich or to become wealthier, or to have higher purchasing power than today, they have to look at alternate avenues, alternate products, alternate asset classes to make more money than the traditional fixed income products, right? So this is just illustrating in terms of numbers as to how you should look at equities versus some of the traditional fixed income investment option. The second thing is, when you have identified that, okay, I have to look at the real return, therefore I have to have long term goals, I have to have a right mix of equities versus gold versus fixed income. Then what do you do next? And what you do next is basically having the courage to buy uh, different products under the different asset classes you choose to buy, right? So so what we are saying here is, obviously, that you need to allocate for your long-term goals meaningfully into equities to create wealth for yourself. Investment is equal to income minus expenses, and not income minus investment, right? So first you decide how much you want to invest. And I've done my CFP. The thumb rule when I was doing my CFP was that 35% of your net take home salary after tax, whatever you make, 35% of that should go into investments, right? So that may be a stretched goal, and eventually that should be the eventual goal for you, that along the way I have to reach towards the goal of investing up to 35% of the post tax income I'm generating, right? So if you are earning 100 rupees, you have decided that 35 rupees you have to save. And let's say, to start with, it's not 35, it is 20, it is 25, but you decide that figure. First you do your investment part, right? And then you plan your expenses, your fixed in expenses, your discretionary expenses. I think it is a perfect way to get the discipline of investing, and this will lead to very good results in long term. So I think stick to this formula of investing. After so you remove your investment first, and then you spend whatever money is left over with you. Now the other part is different asset classes will give you different returns at different points of time. So no asset class is giving you return in straight line. So if it is gold, you'll have few years when gold will do very well, especially when there are crisis kind situation like last year when there was a COVID, gold prices went up and then eventually it came down. So whenever there is a crisis, whenever there is an uncertainty, gold will give very high returns, and then it will just be lackluster. There'll be years when equities will do very well, when economies are doing very well, corporates are doing very well, earnings growth is very high. Those are the times when equities will do very well. There will be real estate cycles. So real estate also goes through a 7-year, 8-year cycle. So there'll be times when there is an opportunity to buy real estate, and there'll be a time where it's not the right time to buy real estate. So on and so forth. So the whole thing about trying to and going with the bias of anchoring that last 1 year equity has given the highest return, so I should be over allocated towards equity, assuming that what happened last year is going to happen in the following year. It doesn't happen that way, right? Every time you will try to predict that, sitting today, if I have to put 100,000 rupees, which asset class I have to bet on, you will typically be motivated to put more into the asset class which has produced highest return in the previous 1 year or previous 2 years. That's the anchoring bias. What you see now, you try to extrapolate that into the future, but it may not be so. If the markets have gone 100% in the last 1 year, Indian equity markets are up, let's say 100% in the last 1 year, it is not necessary that it will go up 100% in the next 1 year. So every year there'll be different asset classes which will give higher returns, and some asset classes will give lower returns, and therefore it doesn't make sense to predict which asset class will give best return in the next 1 year, 2 year, 3 year. And there is where we spoke about asset allocation principle, that depending on your financial goals, and going with a simple hypothetical example of 50% equity, 50% cash, whenever you are allocating your fresh investments, don't predict, just follow your asset allocation irrespective markets are high, markets are low, the interest rates are high or interest rates are low. Just do your asset allocation, go by that principle, go by that allocation, and eventually by staying put for 5 years, 10 years, 15 years, 20-year period, every asset class will give you an average return. We have seen that Indian equity markets have 15%, so you will get that average of 15%. Debt products will give you average return of 4-5%. You will get that average return of 4 or 5% by going through ups and the down cycles, and eventually your average return could be anywhere around 9 to 10% if you follow a simple 50-50 formula, right? So so this challenge of predicting the best performing asset class of the next 1 year, 2 year, 3 year is a task which is best avoided. And I would strictly suggest that you should have something of everything rather than a lot of something which has done very well, right? So try and diversify yourself. And what you see in this chart also is that in the last 2 years we have seen a new asset class which has emerged for Indian investors. Debt was always there, equity was always there, gold was always there. Now we have international equities. So as a equity, within your equity exposure, you can diversify now to buy some of the best companies in US. You have the option to buy some of the best companies in the emerging markets, in Europe, in Japan, right? So you can diversify your equity risk, some proportion of your equity allocation into other geographies, and therefore reducing your risk, diversifying your risk, and reducing your volatility. For example, in last 10 years, if you would have had let's say some exposure to US, very few investors have had exposure to US for the full 10-year period when US has done the best. Your overall returns would have been very different as compared to you would have not, right? So most investors have started to invest in US only in the last 2 years, but at least this new asset class which is emerging is very good, and these options are available to all of us to diversify, and we should have some meaningful exposure into this asset class as well. Again, every 10 years we'll see different asset classes do well. So decade of 70s was all about gold. This I'm talking about global asset classes. So gold was the best performing asset class in the decade of 70s, giving a return of almost 13.7 times. US gave 15%. Decade of 80s was the best. Was Japan was the best market, 5 times return. Gold was negative 35%. So previous decade gold was top. Next decade gold was down. Decade of 90s, US became the best performing market, 5.6 time return. Japan became the least performing market. So best of last decade willy-nilly becomes worst of the next decade. In fact, decade of 2010 was India was the best performing market, right? 4.7 times return, and US went through a downtrend. US went through a mean correction. Last year, decade of 2020, we have just seen that US has given very good returns, 2.38 times. India is negative 33%. Can India be the next decade? Which asset class will be the next decade? So these things will rotate. Different asset classes, as I said, will perform well at different points of time. It's a futile exercise predicting this, and therefore the best thing is to put some money across various asset classes and get an average return. Here is a good example of anchoring bias. When the markets were down in March 20, negative 23%, everybody simply extrapolated that, and people used to tell me that Nifty will become 1000. In fact, Nifty will finish. India will be over. World is over, and sell everything you have. When you saw only a 23% correction, the bias at that point of time was that simply get out of equities, take all the losses and get out somehow. And what we saw subsequently, in less than 1 year, your 12,000 Nifty going to 7,000, and 7,000 Nifty is now back to 18,000, right? So this is how markets will surprise you. In fact, Buffett has spoken about greed versus fear when it comes to investing or making allocations. These are the times when there are deep corrections in equity markets, deep correction in any other asset class. That is the time to double up your allocation, because usually when there are deep corrections, it is always followed by very sharp upside, a very sharp recovery in a very short span of time. So I think the way Buffett has put is very nice. And what he says is that you need to be greedy when others are fearful, and you need to be fearful when others are greedy, right? When the world is selling, you should be the buyer. And when the world is buying, you should be a seller. So this is one example of anchoring bias. Do not get carried away with short-term trends, black swan events, recency bias, anchoring bias. Just simply stick to your asset allocation. Much rather when you are losing money on a short-term basis in a certain asset class, you add more to that asset class and bring your average purchase price down. It will help you make better return in the future. This is again when it comes to selecting funds, because I come from the asset management business. I've been in this business for 22 years. Willy-nilly, I have seen that when people are buying stocks, they want to buy cheap stocks. They want to buy stocks at a low price and sell them at a high price. So when we are buying direct stocks, you want to buy low and sell high. But when it comes to buying mutual funds, we simply do descending order, best performing funds over 3-year period, and we buy more of that. But usually what we have seen is that, and this is the whole bunch of data we have done this study across time frames, the best performing funds of preceding 3 years often become the worst performing funds of the next 3 years. So when it comes to stocks, you are trying to buy low, but when it comes to allocate to mutual funds, we want to buy the best performing fund. Means it is expensive, means that it will go through a cycle, means it will go through a correction. Not that the fund is bad, not that the fund manager is bad, but everything what goes up very, very sharply will also come down, and there is where the law of averages play out. So I would say that when it comes to mutual funds also, one should look at that the manager style, the philosophy, and what lies ahead of the fund. And in fact, I would recommend that the fund manager you like, the fund house you like, you should wait for that fund house to go through a bad cycle, and in the bad cycle you should buy more of that fund rather than selling of that fund. So I think this is the next level of investor education. What is happening these days is motivating people to look at returns from future perspective and not from past perspective. I feel that chasing the best performing funds on an ongoing basis is one of the dangerous exercise for you to make suboptimal returns, and then the whole behavior gap, investor return versus investment return. While the fund, I mean, there's a recent example of a fund, Reliance Fund, which the NAV has crossed some 2,000 rupees, 2,500 in 20 years. But how many people have lived? Only 1% investors. I was talking to one of the people out there. Only 1% of the investors have lived through the entire fund from the start to the end, and they have experienced this journey of 200 times. Not everyone. That's because when the fund would have not done well, you see the redemptions or you see the purchases at the wrong time. Simple point: stop chasing the past. Rear view driving will cause only accidents, and that is where people like Groww and all of us will try and guide you as to how to look at funds from a future perspective. Neighbors envy, owners pride. This is, I think, something somehow, this is a bias which we need to work on. What my friend is owning, what my friend is not owning, how my friend's portfolio is doing, how my neighbor's portfolio is doing. His return is 13%, my return is 10%. So what has he done right? And when you try to imitate what your friends or your neighbors or your family or somebody is doing, and you get carried away with that, is where you lose the discipline, and that again could be a dangerous thing to do. So stick to the decisions you have made, stick to the advice you have got from your advisor. uh, don't get affected, don't get impacted by what others are doing, because your goals are not similar to the goals of your friends and family. You have to have your own plan, you have to have your own products, you have to have your own asset allocation. Not necessarily it will be same as your neighbor. So don't ask what the others are doing. I think that is the best way to not get distracted from the plan you have made for yourself. So last mantra, as I said, is patience to hold. This is very, very difficult. What is success? How we define this is 1% vision. So we spoke about vision, courage, and patience. Vision is actually 1%. Vision. What is the vision? Everybody wants to be rich. Everybody wants to be financially free. Everybody wants to see that they have a good life, good retirement, children happy, everything is good. So that's the vision. Everybody knows that's 1%. 9% is execution. 9% is actually executing what you have thought about. But the whole thing is 90% patience. And one of the preceding slides, you saw that how different asset classes are going up and down on a yearly basis, and that is the time when you react and you get distracted, and you move away from your financial plan, and you start to make mistakes, and then start to chase the best performing asset class or the best performing fund, and there is where all the mistakes start to happen, right? So focus on, I think, the 90% patience part. Spend a lot of time on vision and execution. After that, patience is something which is the most easiest thing to do, but yet very difficult to practice. So I think this is something which has been my personal learning, and I'm still trying to work on this, and I recommend that you follow these principles. Eventually, it's all about compounding. This is a simple, Excel sheet, and what we are trying to show is that on an average, if you have a diversified portfolio with different asset classes, and you make, let's say, average return of 10%, and you let that money compound, or sorry, you keep your duration of 10 years, your investment duration of 10 years, your average return of 10%. Every 10 years you will be doubling your money. So if you have 50% equity, 50% debt, 10% is the average return what you should expect. And at 10%, 10 years, your money will be more than doubling, more than 2.5 times every 10 years. So 10 years, 2.6 times. But if you take it up to 15 years, it will go 4 times. If you take it up to 20 years, 6.7 times. uh, I think we will be having a different people of different age groups out here, but for the younger people, it is all about number of years. Those who are starting to invest at 25, 30, 35 years, you have 30, 40 years to go to compound. Simply do your asset allocation, stay invested for the time frame, and see the magic of compounding playing out in your portfolio. You will be surprised. And I'll give you examples of that out here. Look at Buffett. He started investing at the age of 14, $5,000. This is a dated slide. He's 93 now, and his portfolio is over $100 billion. He decided to remain in equities, 100% equities at all points of time, and he got equity-like returns. He went through all the ups and downs, and the best part is, see, the bulk of the wealth, or the 60% of the wealth, is all after his age of 60, right? His first billion came somewhere around 55, 56. So from 14 to 56, he was still a millionaire. He became a billionaire only closer to 60, and then 3.8 billion becoming 17, 36, 58, and now well over $100 billion. Here is an example of our own Warren Buffett in India. My boss Ramdev Agarwal, owner of Motilal Oswal, he started with nothing, and his story is out there on the YouTube. 0 to 1,000. He made 12 lakhs in his early age of invested, made 30 crores. 30 crores came down to 10 crores in the post Harshad Mehta correction. That 10 crores went up to 100 crores in the Y2K boom, and then there was a crash, and 100 crores came down to 30. So on and so forth. 30 became 550, 550 came down to 250 in the 2008 global financial crisis, and 250 today is well over 2,200 crores. So from early 1990s to 2021, so about 30 years, broadly, his portfolio is compounding upwards of 18%. In good times, it goes up to 24. In bad time, it comes down to 18%. But it is after spending 30 years, after losing 50 to 60% money every 10 years, right? So this is our own example, and this is why they are known as legends, and this is why they are that 1% of investor class which have actually truly created market. And there are many more names, I'm sure you know about them. So I'll end here. Thank you so much for giving me this time and opportunity to talk to you on this very, very important subject. There is a hard stop at 30 minutes, and therefore I had to kind of be a little fast towards the end, but it's it's actually all about, as I said, I'll give you one last analogy again, which I like is it's all about time in the market than timing the market. It is all about time you give to your investment rather than timing your investments. I'm not trying to propagate only equities out here. I'm just trying to talk about in general investing. And investing is not only equities. Investing is all asset classes. Everything is good to a certain proportion depending on your risk profile and depending on your financial goals. So with that, thank you once again, team Groww. Thank you, Namrata, for this opportunity. I look forward for any questions. Thank you so much.
Thanks so much, Akhil. That was very, very insightful. A lot of good, points that I could make a note of. So thank you so much for giving us all the pointers. So of course, I'm sure relate to behavioral. There are a lot of questions because we do tend to make mistakes. Of course, you try to clarify some of them. So we have some questions, and maybe it might just be a repeat of certain things that you've already spoken about. So, for example, the first question is, can you advise if we should do a lump sum amount in a mutual fund for a time frame of minimum 5 years?
Certainly, yes. I think 5 year is a good starting point, and if 5 year is your investment horizon, and you promise that you will be patient for 5 years, then it would be prudent to do a lump sum also. Doesn't make a difference.
Okay, okay. And how do we keep our patience for holding our investments? Like, of
Stop
course.
seeing your portfolios.
Okay.
Stop opening your portfolio every day to see what the valuation is, especially the day market is down, especially the
Okay.
days when the markets are down, especially the quarters when the markets are down. Believe me, from March 2022 to August 2020, I did not open my portfolio because I knew that if I open, I'm going to see a root shock and I will react. I will do something. I will sell something, and I will do some mess, and thankfully it helped me out.
Yeah, that makes sense. I mean, might as well not see it, right? Instead of
Yeah,
seeing it, getting shocked, and then reacting on it, which is so
yeah,
true.
yeah.
Yeah, yeah. I
So
mean, I know people who
if you have
actually.
invested like the earlier question 5 years, then you see your value after 5 years. I mean, you don't need to see it, every day. You're not bought a stock. You're not speculating.
Yeah,
It's an investment.
fair. Yeah. Okay, so for people who don't have huge capital, especially say college students, how do we avoid the greed of making quick bucks?
I think when you are young and you're in college, you're in school, and I can relate to this question because my son is 17 now and he'll be turning 18, and I've just given him a small capital to start investing into equities. I think don't invest with a thought to become rich overnight. You at this age, you invest to learn the art of investing. You should actually hope that you make mistakes, because at early age when you will make mistakes, you will learn from them, and you will be a wiser investor when you are grown up, and when you start to make your own money and you do actual investing for yourself. So I would say that when you are investing at very early stage, do it as an experiment, learn from the experiment, learn from what is working for you, what is not working for you, and don't chase returns at that point of time. It's like one more subject in your school curriculum, right? So I would put
Yeah.
this way.
There's this very beautiful thing, right, which says that whatever we do in our 20s, right, whatever kind of investments we start with, that's the kind of investment that we stick to in the long term as well. So our experiences
Absolutely.
in our prime years eventually becomes our habit. So it's
Absolutely.
it's good to have such habits like investing in equity to start with, even if you're making losses, but at least you're learning in the whole process, right?
Absolutely.
And
Absolutely.
then you'll probably not make mistakes when you have a much bigger portfolio.
Yeah,
So
yeah,
yeah,
absolutely. And
it makes
equities, I think
sense.
the biggest thing is that if you can digest losses, only if you can digest losses, can you make profits.
Can
But
you make
if you
profit?
cannot digest losses, then you can never make profits,
Yeah, yeah.
because you will run away
I,
from the asset class permanently.
yeah. With the
So
examples that you
this
showed at
is
the end,
beautiful
right?
thing
Yeah.
which Ramdoji says when he talks to investors. He says that when you put 100 rupees in equity, assume it is 80.
Hmm.
So day one, you subtract 20 and you assume this is already 80. So then when it actually becomes 80, you will not feel bad, because in your mind you have designed it or wired it accordingly.
Fair, fair.
Yeah.
Okay, great. So during times of market corrections, how do we stay confident about the stocks and mutual funds that we have picked, especially
Yes.
during market
So this is where you need to do your homework. So whatever you own, whichever mutual fund you own, whichever stocks you own, uh, simply Google and see what the companies are doing. Let's say, for example, you're owning X stock. What is that business that X stock is into? What is the impact of the correction? But how is the business doing? If the business is fine and the stock price is down because of some issue like health crisis, or something happening somewhere, some war, it doesn't matter, because eventually the prices will come back. So look at the value in the company and not the price. And to
correction?
understand value, you have to do your research, your study, and which is all available all over the place, right? If it is a mutual fund, open up the fund, see the stocks which you are owning, and if you get the comfort that broadly, yes, the manager is doing a good job, the quality orientation is good, businesses are fine, that should give you the comfort. The quality orientation in a portfolio, your personal direct equity portfolio or a mutual fund portfolio, that should give you the comfort. And now managers are talking to you, companies are talking to you, all the videos are available online. So here, understand, don't focus on price, focus on business, focus on value. The more you will move away from price, uh, the better it is for you in achieving your dream goals.
Fair. Yeah, yeah, I agree. So, how do we decide if any particular stock or mutual fund will even last for say more than 20 years?
You see, it's a very nice question actually. So the way our industry is designed, the way mutual funds are designed, actually it is foolproof. So yes, it is possible that the mutual fund sponsors can change. A fund managed by a X sponsor can change to Y sponsor after 5 years. uh, if that change is happening at some point of time, you just have to see the incoming sponsor, the credibility of the sponsor, the credibility of the new fund manager. Is anything changing materialistically into the objective of the portfolio? And if everything remains the same and you have the same confidence, you can continue. If not, that is the time maybe you can take a decision to switch into something where you get more confidence. So you decide when, if that happens. But usually the schemes have, I've never seen schemes shutting down,
Yeah,
though the companies have been sold. The schemes just continue from one manager to other manager to other manager.
yeah, yeah. You just have to do your groundwork in terms of whom it is getting
Yeah.
shifted to. Yeah, and if you
Yeah.
have confidence in that particular fund manager who's coming in.
Yes.
Yeah, yeah. Okay. Okay. So I think one last question from my side, and then we can end the session. So do you see any form of market correction, especially now with the Fed, tapering and the rate cuts? Any form of
So
market correction is expected now?
So markets are already correcting. From top, we are already down 8 or 9%.
Yeah.
Corrections are always healthy, and after seeing such a sharp spike in or run up in the markets, obviously any meaningful correction only will be healthy for the markets, I feel. But predicting whether it will happen or not happen, when it will happen, how much it will happen, honestly, no one knows, and I would not even want to attempt that. I just want to tell you that we are in a classic bull run. India is going to have one of the best decade. We have already made uh, our view, which Ramdoji has spoken about, that India could potentially be a $5 trillion economy by the end of this decade, and and Sensex could be well be 2 lakh in 10 years, right? So that's the long term orientation. So we are in a bull market, and every bull market will have multiple rounds of corrections. So whatever these
I
8%,
guess that's why
10%,
it's called
15,
correction, right?
yeah, it's a correction. So corrections will happen. Don't read into these corrections as something which is more permanent. Use this as an opportunity to buy more. But apart from that, again, coming to the same topic, it's not about the corrections or the ups or the downs. It is just simply being invested.
Yeah, yeah.
The
Great.
best way to getting into this trap of waiting for a correction to invest, that is more damaging actually than
Yeah.
investing itself. And I know a
Fair.
whole bunch of investors who've been waiting since 35,000, since 40,000, since 50,000. Now it's 60,000. So that's the opportunity loss for those who kept sitting on the sidelines waiting for 35 to come at 40. Today
Hmm.
markets are at 60.
60. Yeah,
So
yeah.
just stick to your asset. Again, if it is 50% equity, just stick to it.
Fair. Sure. I think we're done with the questions. And thank you so much, Akhil, for joining us today. And thank you,
Thank
all the
you.
viewers, for coming in and asking all these interesting questions. And we truly hope you liked the session. So thank you so much and have a great weekend ahead, guys. Take care.
Thank you,
Bye bye.
Namrata. Thank you, audience. Thank you so much. It was lovely talking to all of you.